Hello everybody, Luke Gromen, FFTT. Hope everybody had a great weekend. It's beautiful weather this weekend here in Ohio. A little bit of a storm this morning. Got some baseball in at any rate, so that's good. I had been able to watch some baseball, have a catch with my youngest son. So it was a great weekend with all three of the boys and Mrs. FFTT. So with that in mind, out of the way, we're gonna jump right into some of the questions and some of the thoughts and talk and shop here. So the first one is from Solar. He said that Jeff Snyder said that if bonds ignored second huge CPI in a row, it's because real inflation is a global factor. And if global underlying factors right now are very different than U.S. CPI numbers, look at yields all over the world. They are telling you it ain't inflation. What are your thoughts on Jeff's comments? I'm not sure the bond markets, and in particular government bond markets around the world, are telling us anything because they're not markets. A market is a risk, a buyer who has risk meeting a seller who has risk in their decisions, who are risking capital in their decisions and agreeing upon a price. And what is happening in government bond markets around the world is sellers are selling most central banks are buying significant majorities of sovereign issuance, and central banks don't have a risk of loss of capital. They have printing presses. So by definition, what we're seeing in sovereign bond markets, I don't know that there is a tremendous amount of informational value vis-a-vis inflation or deflation. Maybe on the margin a little bit, but look, if we were seeing deflation, stocks wouldn't be doing what they're doing. Home prices wouldn't be doing what they're doing. Food prices wouldn't be doing what they're doing. So used car prices wouldn't be doing what they're doing. So I think, when I look around the world and say, okay, cars, food, land, real estate, houses, stocks, all going up, and government bonds saying, hey, deflation, I'm just not, I think the issue is I think the odd man out is that they're not markets. They are political utilities with the price being set for political reasons, for political expediency by central banks. So those are the thoughts there. From Charles, if the FFTT case for selling some Bitcoin is rooted in the anti-Bitcoin rhetoric from some corners of the U.S. government, does the pro-Bitcoin legislation coming from some states and foreign nations mollify those concerns to an extent? It's a great question. I think just to clarify, the case for selling some of my Bitcoin to basically pay off, to basically get debt free, was rooted not just in the anti-Bitcoin rhetoric from certain corners of the government, which has been around for a long time in some form, and quite frankly, I didn't really pay much attention to, but it was really what caught my attention was the anti-Bitcoin rhetoric taking a much more dark turn, for lack of a better word, maybe a neocon turn in the last month and a half, almost following some Iraq War II rhetoric, where there just seemed to be this decision somewhere that was made, and regardless of the facts, regardless of how it would hurt America, there was a conclusion that wanted to be reached, and it was going to be pushed forward. And it seems like, once again, facts don't matter. There's simply a narrative being pushed with a specific end in mind. And so I wanted to hedge my risk to that, having lived through the Iraq War II, where you sat there going, okay, 9/11 is this terrible tragedy, we think we know who did it, and now we're going to go bomb Iraq. And you kind of go, wait, what? Why are we going to do that? And at first it was, well, there's no way we'll do that. And no, okay, we're doing that. Well, we won't be there long. And then 20 years later, here we are. So I just, understanding, having lived through that, and again, there's not a specific, concrete, quantitative thing to point to here. Some of what I do is just basically use experience and intuition. And there just, to me, was this tone change in the last month and a half. In the long run, I don't think it's going to matter for Bitcoin, to be clear. I don't think it will. But I think in the short run, it introduces volatility, and I just wanted to head some of my own risk to that. And I wanted to be transparent for my clients to that. And that's why I share that out there. And again, still own a substantial amount of Bitcoin. So just wanted to clarify on that. And so it's a great question. From JP, is the milkshake done or not? Look, as originally defined, the milkshake was dollar up, stocks up, rates up. And if we define it like that, and it was basically rates up, capital flowing here, stocks up, dollar up, a virtuous cycle. That virtuous cycle milkshake, yeah, I think that's done. U.S. debt is too high. U.S. stocks are too big a percentage of consumer spending, and as a result, too big a percentage of GDP and U.S. tax receipts. U.S. net international investment position, or NIIP, is too negative at negative 65% of GDP. And so all of those three factors means that now if the dollar rises too much or rates rise too much, stocks are highly likely to fall. And so if we define the milkshake as I understood it to be originally defined, then yeah, I think that's done by virtue of where the NIIP is, where debt is, and how important stocks have been allowed to become via policy as a driver to the economy. Now, if the milkshake is simply the dollar going up, as it's it seems like some people that are quoting Brent saying it's just the dollar up is the milkshake. Well, no, can the dollar go up? Absolutely, the dollar could go up. The dollar could go up a lot. Look, if the Fed came out tomorrow and said we're going to sell all $8 trillion out of our bond portfolio by July 4th, I guarantee. I got to be careful. Guarantees are very. It is highly, highly likely that the dollar would scream higher. Stocks would likely crash very rapidly around the world, and treasury yields would actually probably rise, potentially significantly. Corporate bond yields would rise, potentially significantly. So, can the dollar rise? 100% the dollar can rise. Can we have the dollar rise, stocks rise, and yield rates rise all at the same time? That I think I think that ship has sailed. From DB, what is the impact of the Basel III net stable funding ratio requirements on gold and silver in terms of price movement and future volatility? Another great question. I know we're only 2 weeks out, 3 weeks out from it going live in Europe and in the U.S. January 1st for the U.K. still at this point, as far as I know. It's too early to tell, even with that, but all else equal, it seems to be forcing, these rules seem to be forcing an unwind of the unallocated gold market in London. And if that is the case, I think you will see an increase in gold and silver volatility, all else equal. And I think over time you will see higher prices for both. And then the final question from AZ. You state that inflation will be more persistent than consensus expects. Hence, bond yields will rise, which will force the deficit to rise to unsustainable levels. This inevitable dynamic will force the Fed to implement yield curve control. What if the Fed and primary dealers find another way out? And this will also tie in another question from VT about the U.S. government's desire for negative real rates. And these both tie in. So I think there's always another way out. The U.S. government could slash spending on one of its two big non-interest expense items, which are entitlements or defense. They're nearly 100% of tax receipts just on their own, those two line items. The problem is that if you slash them, I think slashing them is in my opinion, politically impossible. And it's really economically impossible as well, because if you slash entitlements, Americans are going to have to save a lot more money because they've been counting on those entitlements, so they didn't save as much in the past. So if they start saving going forward now, not only are they going to have less money in their pocket today from the entitlements, but they're also going to need to start saving more of every incoming dollar. And so consumer spending would fall potentially quite precipitously when you look at the percentage of U.S. Personal consumption expenditures that's being driven by government transfer payments, which is, last I checked, over 30%. Big number. You would be in this situation where Americans saving more money, they're not getting as much money, U.S. consumer spending falls, consumer spending is 65% of GDP, GDP falls. Once you have GDP fall with debt to GDP at 130%, as it is in America, and high elsewhere around the world as well, but 130% debt to GDP in America is, if you have GDP fall, it's a recipe for a U.S. debt crisis. What does that look like? That looks like stocks down, yields up, which is exactly what we saw after 12 days of a sharp sell-off in March 2020. We saw yields up in October 2020 after about a 6% sell-off in the NASDAQ. We saw yields up about a month ago with a modest sell-off in stocks here in the U.S. So that's, I think, ultimately the challenge of running another playbook or running a different tack. There's always other choices, The challenge is based on the decisions we have made over an extended period of time from a policymaker standpoint, from a voter standpoint, in America in particular. The choices we have left are bad and worse. There's no longer really appear to be any good choices. It's bad choices and really bad choices. So that's unfortunately the lay of the land. So with that, I'm going to wrap it up for tonight. I want to thank everybody again for joining us here on a Sunday night catch-up. Always enjoy doing these. As always, if you are interested in finding out more about what we're up to, check out FFTT-LLC.com. You can also learn more about our product Tree Rings there. It's a weekly synopsis of 10 most interesting things we've read that week. Getting a lot of great feedback about it. You see some of that feedback we put up on Twitter. So at any rate, everybody have a great week. Stay safe out there, and we'll talk with you soon. Take care, everybody.